The yield on the 10-year Treasury note rose above 3% on Tuesday, its highest level since January 2014. The main force behind the rising yields is growing speculation that the Federal Reserve will be more aggressive in lifting interest rates. Yields started heading higher after a number of Fed officials rekindled the idea that the central bank could raise interest rates 4 times in 2018 and not the 3 times previously expected. Anytime interest rates rise, it can have a significant effect on the economy and on your finances. When the Fed announces a federal funds rate hike, that means that it increases how much banks will be charged to borrow money from other banks. The rate increase eventually trickles down to consumers, and it can affect your credit card debt, your savings account, and even your mortgage. Credit card interest rates are variable, and they're tied to what is known as the prime rate. The prime rate is an index that's just a few percentage points above the federal funds rate. So when the Fed raises the Fed funds rate, the prime rate also goes up, and up goes your credit card interest rate as well. The kicker? Banks don't need your consent to make that change. They'd probably just hit you with a higher rate within the next 2 billing cycles. The average American household is paying around $1,300 in credit card interest every year. So check with your credit card company. You'll want to know if your interest rate is on the rise. Second, it's not all bad because the rate hike means your savings could actually grow. So far, savings rates have not really increased in most banks, but they should increase slightly as overall savings rates are at historical lows. To get the most benefit, consider switching to an online-only bank where savings accounts often have a higher return. Third, for homeowners, it's a completely different story. When the Fed raises rates, variable mortgage rates also rise. So if you have a variable interest rate on your mortgage, be prepared to pay more every month. On the other hand, if you have a fixed rate mortgage, you won't see any changes. But there's a catch. If you were hoping to refinance, you actually just missed out on good savings. Now that the Fed has raised rates, you can no longer lock in that low rate that you were hoping for. So while the Fed rate hike is not all bad news, make sure you read the fine print.